For more, let's bring in Jonny Fine, Goldman Sachs, Head of Investment Grade Syndicate. Jonny, good to see you. Thanks so much for joining us.
Thanks for having me on, Will. Great to see you.
So let's talk about those rising inflation expectations. If we do see a scenario where Treasury yields rise significantly over the next year, do you think spreads would gap out as well, or do you think they'd stay relatively tight?
I don't think they'd gap out, but I do think there's going to be a relationship in that if there's a meaningful move higher in yields, that there would be a move wider in spreads as well. Now, at the same time, I think we have to remember that the Fed continues to buy treasuries at a prolific pace. So I have to believe that with a rise in inflationary expectations, and indeed as part of their average inflation targeting policy, I think they let inflation run a little hot, but at the same time be more aggressive in buying treasuries to ensure that we do have a lot of stability in the treasury market to stop those types of derailments specifically.
Clearly this year there's been a huge amount of debt issuance, equity issuance as well. Do you think next year, therefore, will be fairly soft on those fronts?
I certainly think that the credit issuance component of the market will be quieter than it was this year. We're going to finish out around just under $2 trillion of aggregate supply in U.S. investment grade. I think next year you'll see more of a moderation to what we used to see annually in 2018 and 2019. That's more like $1.25 trillion. I'd probably flex that a little higher, so maybe 1.3 to 1.4 trillion. It'll still be pretty busy, but nothing like the very specific one-off year we've had this year.
What sort of warning or message are we getting, Jonny, overall from the credit markets? It's such a positive indicator for stocks between the Fed's intervention and the prospect of more fiscal stimulus and the vaccines. It's all been very market friendly. Does that continue to be the case in the credit market, still giving the green light for the rest of the markets?
Yeah, I think it does. I think there's been obviously the prospect of the Fed renewing their asset purchase program in credit into next year. That's now been taken away with the program expiring at the end of the year. But we're now a handful of basis points off of the absolute tights of the year in investment grade credit, and that's even pre-COVID. That's around 275 basis points off of the wides. So it's reasonably clear to me that credit's signaling pretty much the all clear insofar as risk is concerned. Now, obviously things can change as we get into 2021, but as things stand right now, there's certainly no canary in the coal mine from credit markets.
Jonny, what are companies telling you that's on their mind of what to do with cash if they've raised too much this year?
I don't think companies think that they've raised too much. I think that they would say that they've been appropriately conservative. Obviously, no one plans for an economic shutdown like we had earlier on in the year. That's one of the reasons that drove the stockpiling of cash that we continue to see evident here today. Companies, as they think about things right now, I think they'll review maybe the first half of next year as a time to continue being appropriately conservative until we see what the real economic picture looks like post a successful deployment of a well-distributed vaccine. And then once we've got through that, I then we'll start to see corporations naturally look to pare down those cash balances. As to what they do with it, that's obviously a big question for 2021, and one that obviously both credit and equity investors, I think, are going to find fascinating to watch.
Jonny Fine, thanks for joining us.
Shepard Smith here. Thanks for watching CNBC on YouTube.